All right. Looks like five. Good here. Looks good. Audio looks good. Okay. All right. So it's been a while. Welcome everybody to Nice Investing Live. I know last couple shows I've had, I made professions that I was going to attempt to get to some sort of regular schedule with my shows, and then time I haven't really done that. So here we are once again. Hopefully trying to get back to once every other week or so sort of scheduling. We are at least luckily being now with our third macro devoted show, which is what we're doing here today for Q3. Or really, it's the end of Q3. We're moving into Q4 now, but the point is, I'm going to be covering all data that was available as of end of Q3. But yeah, we've done that three times now over the course of this year. I am trying to do that, but really it was the other shows in between the quarters that was a little bit less consistent. But we'll be getting to that. So anyway, first off, before we get to that stuff, I will comment a little bit on my portfolio and time. Um, One thing in particular today, there was news of a buyout for Heidrick and Struggles. So here it is, up approximately 20% today, up to about $50 change. There has been a buyout announcement on the investor relations page of $59 per share in cash. So that's why it's trading at like 50 change because it's trading slight little discount to that value. Looks like it's supposed to be closing in the first quarter of 2026. And I sold out of my position like less than an hour ago. So good. We're good on that. We're happy with that. I did sell out of my position, like I said, but I haven't actually input that information uh, into my transaction spreadsheets. Therefore, it hasn't filtered into this display right here. Partially because I did want to kind of like comment a little bit on the position to kind of show it a little bit, and was looking at the metrics for it. So it's as you see right here, currently at 5.1% of my portfolio. I have trimmed some amounts of my total position on that at some points. I don't think it was a huge amount. I don't think it wasn't. Well, definitely wasn't more than like 20-25% of whatever the total amount of shares was. Might have been like half of that, honestly. Might have been only like 10-15% or whatever. I can't remember exactly how much. I know it did trim a little bit at one point or so, or maybe even a couple points. But either way, like I said, it was only like a couple shares here and there. Really, it wasn't a lot. But the point is I'm kind of happy with this particular move because I think I'd even commented on it a few times here and there in previous shows when people kind of like making comments about what I was thinking about maybe doing in near terms in the future, and pretty much I often remarked that this one is not super cheaply valued. It's done well, well relative to our expectations. It's a relatively healthy allocation in our portfolio, and it's relative to, for example, other positions that I kind of count in my theme strategy. Meaning, I'm focusing a lot on like the industry and the story and how that's going to develop over the next 10 years in particular, and how the company themselves can do well within that industry over the next 10 years. Is my more theme-based, long-term strategic positions. Uh, I counted Hydrogen Struggles as one of those positions, but it definitely was different than some of the other positions in that kind of bucket because it didn't really have very large growth expectations in terms of revenue. I it still fit within the theme, specifically like aging demographics in the United States, because they had a focus on executive search and executive replacement within the suite. And so with the aging out of the boomer demographics and the bringing in of more Gen X and millennial executives, that was going to require expertise in that area. So I was pretty happy with that position. But nonetheless, all the research I did on it, I didn't necessarily see a huge reason to a huge amount of revenue growth over the time frame. It was just very strong confidence in the cash flows that they were going to be able to generate, and they had a little bit of a swingy kind of stock to them if you kind of looked at them. So like it honestly provided opportunities. I mean, I really started getting into them 22, 23. I can't remember exactly when it was. I think it was like mid 23 when I started getting into them. It was like I was just kind of like looking at their kind of behavior as a stock. It was like, well, even if it's not a huge growth story to it, there could be opportunities to kind of sell out some shares, buy in some more shares, sell some more shares, buy in some more shares. I'm kind of comfortable with that kind of position if I think like I said, the business itself was good. So that's kind of how I treated the position. But the point is either way, I was kind of like wondering, okay, well, at what point would I maybe want to get out of it altogether then? And that's always bearing, other opportunities and stuff like that. So with today, them getting the buyout opportunity, which is up here at $59, pretty high. That puts them highest price in 25 years. They did have some crazy spike ups here when they first went public in 2000, 2001. So good for them for getting up to that point there. But either way, that takes us out of the position. So, like I said, it doesn't show it in here, but technically I do have that in cash right now, which I'll probably be throwing that into my ETF strategy by the end of today. I just, like I said, didn't quite act on it yet. So I kind of made the sale out of it before the stream, but didn't enter into the new position since then. But either way, like I said, it'll probably go to my ETF strategy, which is kind of my default place to put things when it's not when I don't have a position I want to put it in. Because most of my other positions, I'm honestly over allocated on, or the position is is uh, you know relatively richly valued. So it's that's kind of my situation with both my positions. Like my gold miners, a couple of them I think are relatively fair valued. A couple of them I still think are basically cheap. But nonetheless, the gold theme is strong right now and in motion. So I'm not really trimming them because they have good momentum both in their fundamentals and in their stock prices. I mean, on that note, for example, Orlo is up 10 to 11% today, although they've been zigzagging a lot here near their peak. So really, this 10 to 11% here today is really just them kind of digging back up within the zigzag there. They're a bit volatile, but whatever. Looking at gold itself, we're up over $3,900 an ounce. So it's just like, man, I think last time we talked, we were at like 36 or 37 or something. Maybe it might have been even lower. It might have still been down here. I can't really remember 100% when the last stream was. So either way, flying up, flying up. We're almost at $4,000 an ounce. I did trim my gold miners a little bit at various points in the last couple months, and I mean my total allocation to gold miners is pretty hefty now. Even though I've trimmed a little bit of them, but they keep appreciating. So it's just is what it is. We're at 11, 12, 15, 17, 18 or so plus this, so 28%. I'm like at like 28% allocated to gold and gold miners. Well, gold miners, and technically silver miner. SPM is a little bit of that allocation for commodities here. So yeah, we're very very allocated to gold. With the gold trust portion, I'm not really worried about this portion of the allocation since it's fitted into our ETF strategy. So if we lose momentum on gold metal, well, this will automatically start to lower its allocation. However, the miners, obviously, I do have to kind of monitor that. But like I just said, a couple of them I think are relatively fair valued. A couple of them I think are still a little bit on the cheap side within that. So it is what it is. But none of them do I really want to let go unless I think they're actually kind of richly valued. I don't really want to just at fair value per se start selling out of them. Though I will trim them in terms of size. They are definitely over allocated in my so, but either way, these are great problems to have. Great problems to have is when you're over allocated to something because it's just been appreciating like crazy. So, pretty good on that. Pretty good on that. Also, I didn't comment on it, but with Heidrick& Struggles, 5.1% of the portfolio, this actually ended at approximately 101% total returns, including dividends. That was over a weighted 1.7 years, 55% annualized returns on that. So pretty satisfying on that. Would have been great if it was 10% of the portfolio instead of 5%. But hey, whatever. Still pretty good on that. So that's kind of the update to the portfolio. Like I said, not too much changes other than selling out of HSI today, but that we were going to be out of that position in the first quarter of 2026 when they closed the deal one way or the other. So we figured we would just get out of it now. The worst case scenario is the deal cancels and it goes back down. Maybe we could hop back in. Seems unlikely. Definitive arrangement. Blah 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 blah. $50 per share. It's, by the way, I didn't actually mention it, but it's a private equity consortium that's buying the company. That's kind of interesting in itself. A little bit of a global exposure they have. A lot of stuff in Europe as well as the United States, which I think kind of fits well with Heidrick and Struggles because they themselves have a lot of business in Europe. So I don't know. I didn't look super deep into it, but I did go briefly to the fund's website to kind of take a look at who was buying the company. But interesting. Nonetheless, we are out of it. So with that, we will go on to talking about economy now. We're going to do our little Q3 economic update, which I have lots of data to show as I've done with my previous economic updates. So let's get ready to have a lot of stuff thrown at you, but it'll be pretty interesting, pretty fun. What I will say right off the bat is, a lot of people, a lot of the headlines, a lot of people's opinions on the economy are all over the place this year, largely because of how much it's been politicized. And for better or worse, no matter what side of the political discussion you're on, people are doing their best to basically only look to see things that really kind of confirm their own perspectives, or at least that's my views of things. And admittedly, I tend to not really agree with people on a lot of spectrums when it comes to politics. So I think that gives me the ability to kind of look at people's opinions in that way. So what I will say is, no matter what you hear today, I'm going to be showing you lots of data. Hopefully that doesn't ruffle anybody's particular feathers, because in some of you will probably think that I'm saying the economy is stronger than you think it is, and other people will think that I'm being too critical of the economy in other areas. So, the point is, I'm not going to please everybody because I think a lot of people's opinions are very politicized, but I'm going to be showing you data. So hopefully that keeps things clear. And I do think there's some very strong misconceptions about how the data works and also how it's collected, that has caused a lot of people to believe they understand what's going on this year in the economy in a lot of ways, but there's a lot of misconceptions on the front. So anyway, here is our business cycle tracker, which I've shown now for close to a year. I think I started showing this in like November or December of last year or something like that. It was right after New Year's, I think, actually, January. So 9 months or so, but whatever. My business cycle tracker, as I've kind of shown here, there's a lot of pieces that go into it, but this is kind of the broad overview of it. So I wanted to show that right off the bat because you kind of get a picture of what we're looking at, and also all the pieces that go into it is a lot of stuff, so it can be a little confusing to look at, but it gives you an idea of like what it is. It basically, if it's negative, it tells you that we're in contraction. If it's positive, we're in expansion. The deeper in contraction it is, the more likely it is that that's true, versus the higher it is, the more likely it is the opposite is the case. And it's composed of a lot of different pieces. So the point is, it's not really meant to say that like, oh, it's an absolute thing. As you can see, it's a pretty good tracker, but sometimes it's early, sometimes it's a little late. It's not perfect. So obviously, you can point out that right now it shows that we're kind of in a positive value here as of the most recent data, but it is relatively close to zero, and we've spent the last 2 years or so really in kind of this like somewhat negative, but not really quite super recessionary territory. Deal with recessions, we do tend to get pretty deep down here, usually down to like at least -10% in terms of the value itself. So while we were in spending in negative territory, we weren't really quite into the levels that um, truly confirms a recession. Which it kind of goes in line with what a lot of people were referring to over the last couple of years as the rolling recession. What some people were referring to is basically arguing that some sectors of the economy were in recession, but other sectors of the economy were actually quite strong. And so when you looked at the broad average aggregate data, it was showing that we weren't in recession, even though there were significant sections of the economy, like residential, for example, that really, really did feel like we were in recession. So that's how a lot of people have come to describe it. So anyway, going on to show you the pieces that go into this. Um, this is the most this, like I said, this is kind of the historic chart that shows it, but here is a chart that shows kind of the stereotypical pathway that this data takes with the blue line in and around recession. So you're going to see kind of this format of this chart where the black line shows essentially the month where the recession begins, and then the x-axis itself shows how many months into the recession or before the recession, and then this line itself is literally a median value of that previous cycle. So it's effectively uh, the same information as this line right here, the red line, but it's showing basically what the median pathway it is for that line around all of these recessions right here. Okay, so it's important to kind of understand that. And then looking at this, that blue line itself is composed, in fact, of all of these separate pieces right here, which are different cycles within the economy. One cycle being liquidity, another being stocks, another one being credit, which is like debt extension, another one being corporate profits, another one being growth, which is the actual real GDP growth itself, another one being employment, another one being policy, which is the Fed funds rate, another one being inflation. And then I also have the yield curve shown on here, which isn't really a cycle, but it kind of fits within showing this picture. Although the yield curve is unlike all the other ones, which are shown to be positive going in and around the recession, and then going negative as the recession begins, and slowly going positive as the recession ends. The yield curve is negative prior to the recession, and then becomes positive approximately at the time the recession begins. But so I just include that because that's a very common recession indicator people like to use. So I kind of wanted to show that the context of this analysis. But anyway, like I said, this is kind of like the stereotypical pathway that all of these different parts of the economy take going into a recession. And then this, how each of those pieces look as of right now. If we were to take the most recent month that ended, that being September, and said, okay, what if we assume that the recession begins here now in October? This is basically how the data all looks. And so what I will point out is that, it's a little bit of a mixed bag if you look at this relative to this. There are a lot of these are kind of coming down, as you can see right here, which gives kind of a negative aspect, but many of them were very much negative for quite some time, which again fits into that whole idea of a rolling recession that we may have been in for a couple years, actually, to a certain extent. And you can argue in some ways that we're sort of recovering now from sort of a shallow recession. Like looking how you can see like the belly of this curve is over here, kind of, and then over here the belly is over here, which gives the argument that recession began potentially some time ago, like maybe like a year ago or so. We had like a brief recession or something. It just didn't show it fully in the data because, well, we tend to use uh, growth, which is real GDP growth, and employment as like the key things that tell us did we go into recession or not. And while growth and while the employment here was kind of negative, it wasn't drastically negative. And growth, the purple line, you can see didn't really go negative at all. So like the combination of those things, those being kind of the biggest weights in terms of like how people think of recessions, it didn't really feel like a recession, even though a lot of these other aspects you could see we're kind of going that way. So looking at each of these independently, here, look at each of these independently. I can show you how they look in and around recession. So here's the yield curve, as I was saying before. The yield curve or in and around recession usually is negative prior to the recession for quite some time, and then as the recession begins, it starts to straighten out into a normal yield curve, which it then kind of stays normal for some time afterwards. And here again, you can see it's as though the recession began like 12 months ago or something like that, and well, say that we're still in recession or we're maybe potentially starting to come out of it. Like I said, this signal doesn't give you much in terms of are we coming out of it. It just says, well, it would have began like 12 months ago. Looking at liquidity, liquidity also has a pretty negative drop off. You can see right here. Now this drop off sometimes it tends to begin prior to the recession, as you can see right here. Like the drop off begins like 9 to 12 months prior to the recession. However, it still continues that drop off into the recession itself, really only reaching its trough like 6 to 9 months into the recession significantly. So within that, you could argue that it beginning right now actually somewhat makes sense, or you could argue that it's going to begin a handful of months from now. Like you could argue like a handful of months from now, or you could argue that it actually did begin like 9 to 10 months ago. So like this one, in some ways, you could kind of use this particular one to paint whatever story you want a little bit. But nonetheless, liquidity is quite negative right now, which in that information, the fact that liquidity is negative right now, because that actually has some other factors that's relevant to us investors that we'll discuss a little bit once we get through most of the rest of the data. But because liquidity and the economy, while they're related to each other, liquidity, as you can see right here, is part of my business cycle analysis. It is the thing that's more relevant to stocks than basically any other part of this discussion. Um, Going on there to talk about stocks, you can see the stocks tend to be peaking at like 12 months prior to the recession, and then they kind of go on a little bit of a downslide in terms of their rate of growth. This isn't really about like the level of the stocks; it has to do with more of like the rate of change for the stocks themselves. But then it starts to roll over over that 12 month to 6 month period, and then goes negative for that 6 month prior to recession, and is already significantly negative going into the recession, and then tends to kind of bottom 6 months into the recession. And here you see we were negative long time ago. Obviously, this is probably harkening back to like 2022. And then while you can see April as well kind of appears as a little bit of a divot on the chart, but you can see kind of recovered from that as well. So stocks are more in recovery, which definitely does not paint more of a picture that we're in recession. This makes it look like we're kind of way over here on this part of the chart for stocks themselves. And then credit, which is like debt extension to businesses so they can expand their businesses. It itself also paints a little bit more of a recovery picture. This one tends to take a little bit of time recovery. So this one shows a relatively brief negative period that seems to already be somewhat recovering, though it has flattened out. So you could argue that maybe it's just kind of doing a little bit of a potential rollover a little bit here. You can see it does curve a little bit sometimes. So, we'll see. But as it currently paints the picture, it looks more like a recovery than it looks like a recessionary outlook. But it could potentially roll over. So we'll see how that looks in quarter from. Going on from that, there's corporate profits. Corporate profits also previously were negative and have now started to inflect in terms of the rate of change of growth, which is not really in line with the recessionary picture themselves. And then there's GDP growth itself. GDP growth itself, as you see, rolls over at approximately the same time that the recession begins, which is why it is the measure we tend to use to think of as whether we're in recession or not. The stereotypical story is that 2 quarters of negative GDP growth equals recession, which is not technically true. Really, it's the NBER that declares recessions, and they take GDP growth, but also business investment, employment, are factored into account. And really, as I said before, it's like GDP growth is a huge weight in there, but so is employment. So it's like if you have 2 quarters of negative GDP growth, but employment seems like it's relatively stable, then they're not going to declare a recession. It has to look like employment is actually falling apart. But anyway, so diversion from that. The point is here you can see GDP growth is probably the cleanest one in terms of it beginning at that point of the recession begins because of that. Like I said, it is weight there. But nonetheless, we're downtrending. We're certainly downtrending in terms of growth, but we are not in recessionary territory as far as that goes. And then employment, as I said, kind of also in line with that. Also not in recessionary territory. However, the tricky thing with employment is that you can see here, it always looks decently fine at the start of the recession. Employment is one of the most lagging aspects of the business cycle. It really doesn't start to truly fall off until 3 to 6 months into the recession, and then reaching a trough 6 to 12 months into the recession. So the point is like it looks fine right now, but as you can see, it also looks perfectly in line with the potential recessionary pathway. But the point is it also would have looked that way through all of this time frame right here. The point is employment is just not a very good leading indicator for the business cycle. It's the thing you're trying to predict, right? It's not it is like this is the thing we actually want to know about. Like yes, we want to know about GDP growth, but really what we want to know about is when are people going to be unemployed? Because that's the thing that decides the severity of the recession as well, right? So like that's the thing. Like this is the hard thing to predict. So yeah, it looks fine right now, but it also looks like it could fall off a cliff. And frankly, it kind of always looks that way until it does fall off. So yeah, very, very difficult to look at. It looks fine right now. We'll see how it looks in a few months from now. Obviously, there's a lot of concerns people have pointed out to about the labor market. And I did obviously put jobs in the title of the stream, so we will certainly talk a little bit about those difficulties. But I am trying to get through kind of the mainstay of my economic data that I like to talk about first, and then we'll talk a little bit more in detail about some of the jobs data and I think some of the trickiness with trying to decipher exactly what's really going on with the jobs data this year because I think I have some clarity to provide there. And moving on from there, we also have policy, which is the Fed funds rate. So this chart's a little bit tricky because of how low interest rates were for so long, and then how fast we raised them. That basically means that the way I assess the metrics for all these charts is based off of kind of like a normalized metricing system. And so the normalized metric for the policy rate was extraordinarily high because of the fact that we had gone from a very, very low level to a relatively high level soon afterwards. So the point is, this red line is actually on the right axis, whereas the left line is the left axis. Whereas most of these other charts, I had tried to keep them in line with each other. Or never mind. Actually, I never mind. I think I had changed the charts after my last show and forgot about that. So they're all on the right hand side here, but nonetheless, most of these are close to the same scale. Whereas if you look at the policy one, here it scales from 0 to 60, whereas over here it scales from 0 to 0.75. So it's like you got to keep that in mind when you're looking at this. That um, really it's like down here it shows it super low, but it still shows 1, 1.2, 0.75, 0.5, 0.2, 0.0. And like yes, it is getting close to zero right here at the month here, but like on this scale, you would see it right over here. In fact, let me try to show what I'm talking about. I think I'm just making it confusing talking about it. Um, so like I put that over to the left hand side. Now let me shift the vertical axis to max of 1 there. Okay, so this is what I'm talking about. Is that like this line? I tried to bring it back to basically where it was previously, and here you can see like it's just zooming down way really fast. And it is now close to basically zero, which basically means it has it is still high at a high enough level that it is potentially restricting, and that logically makes sense given where the policy rates actually are. Though it is still in positive territory, which means it isn't necessarily too restrictive. It's just potentially close to too restrictive. But now you can see like what I meant, that like that previous curve showed it way over here, but really we were way up here, and now it's kind of in line, which you can see for the Fed funds rate. This also tends to go down after the recession begins, and that's because, well, usually they're dropping the Fed funds rate as a reaction to the recessionary condition, not to try to prevent it. So put that chart back the way it was. Or I'll fix that. I'll fix that. Moving on from that, then there's also inflation, which is basically the last of these. Now, inflation also tends to be a little bit of a lagging indicator, and also for inflation, metric is reversed. So it shows this going down, but what how I have this is that down is a negative for the people experiencing it, and positive is a positive for the people experiencing it. So inflation is not good, right? So that means when it's down, that means inflation's actually above average. It's damaging to the people experiencing it, because we wanted all the charts to point down for a recession. And the thing about inflation is that inflation tends to actually be above trend going into recession. It tends to be hot going into recession and spiking a little bit up to 3 to 6 months into the recession before it starts to roll over, and then really only like 6 to 12 to even 18 months after the recession ends does inflation really break down and go durably below the trend. So pointing that out here, you can see that the line is below that, which makes sense because inflation has been higher than normal, above trend, which again is actually more in line with the recession having been taking place some time ago, like more like a year or two, maybe 3 years ago, based off of the chart is framed here. However, you can see it is also starting to roll over again, because basically stopped our decrease in the uh, the the rate of inflation really like 6 to 12 months ago. We basically kind of bottomed, which I've been talking about on this channel for quite some time. A lot of people have been talking about inflation going up in the last like 2 to 3 months, usually in a very politicized way, because of tariffs and things like that. But if you had been watching this channel closely, you might have known that I've been talking about the fact that inflation was going to start going up in 2025. I was saying that all throughout 2024. So the point is that shouldn't actually be a surprise. Frankly, in my opinion, it doesn't really have anything to do with the tariff. It has more to do with the deficit, the budget deficit, which the new administration has also not helped on. The point is like people want are I think trying to blame the current administration for potential rebounds in inflation, and they certainly deserve their blame. But a lot of people are trying to blame the wrong thing. In my opinion, a lot of people are pointing to the tariffs. Like, well, if you really understand how inflation works, that doesn't really cause broad-based inflation. That just causes price increases on those particular goods. But unless the money supply itself increases, there you're going to have a drop in price on other goods. Now, there isn't going to be a drop in price on the other goods because there is increase in the money supply, but the increase in the money supply isn't caused by the tariff, caused by the budget deficit. So that's the thing. It's like you gotta understand like the actual causes of inflation. The actual causes of inflation are government money printing and private bank money printing. Like those are the two ways that the inflation is created. You just have to then wonder is what's the time lag between that, because where did they put the money in the short term, because it doesn't necessarily go straight into the economy immediately, which is why there is a very strong correlation between the M2 money supply and CPI inflation rate on a direct basis, because there's a you can essentially shovel money into assets to keep it from going into consumer price. But nonetheless, that is the source. So anyway, going on from there, a little bit of a diversion talking about inflation and prices and stuff like that. We're going to talk about plenty of inflation data more to come as well. But anyway, the point is, I would argue that this looks more like we came out of recession, like I said, though it looks like maybe potentially we're rolling back over into it a little bit as well in that regard if we can't continuously cool the inflation further. So putting all those pieces together, this is the composite, which I kind of already showed you before. This is the stereotypical pathway that we go through in and around recession if you put all those pieces together. And then the red line shows how that data currently looks as of right now, which this red line is the same as this red line right over here. Like this is literally the exact same data over here as you see right here. And then the yellow line, what is me taking that same data and kind of pushing it forward 6 months to kind of try to realign it, say, well, if maybe the recession isn't beginning right now, how does it look if we were to say maybe the recession was beginning 6 months from now? Kind of just like a way to kind of test it to see if I can kind of get a picture of how it looks. And well, not the cleanest look. Like I said, it certainly could roll over. It certainly could. But as I had already kind of pointed out, we were really more negative territory through 2024, um, and like the back half of 2023. There were parts of the economy that were very strong in 2023, 24, which is why we didn't go into recession. But there were other parts of the economy that were quite weak. Those parts, in some ways, are starting to recover, whereas other parts of the economy then have also started to get weaker in this year. So that's why it's like, we're still kind of hovering around this 0 point here. It's still kind of hovering around not particularly strong at all, but it certainly isn't really rolling over into recession, at least yet. At least yet. Make whatever theories about what you think is going to happen, but um, I heard those theories 3 months ago, and I heard those theories 6 months ago, and I heard those theories 9 months ago. I've showed you this exact same data now 3 times over the last 9 months. So, the same data with 3 months added to it. So the point is I've my story about interpreting the data hasn't really shifted too much over that time frame either. So I think that points to the consistency both in story and in my data. So anyway, going on with that, I did say put a pin in liquidity because I did want to kind of like point out the importance of liquidity because as I mentioned before, liquidity tends to fall apart significantly before the recession begins, and also stocks tend to fall apart significantly before the recession begins, which means that you can't really use this kind of economic data very as a very effective tool for trying to predict when stocks are going to crash. Whereas even though a lot of people like to do that, the reason why is because liquidity is really the thing that has more to do with when stocks crash. But liquidity tends to have its biggest rollovers before recessions, and so that's why there tends to be big stock crashes associated with recession because they just go together. So I've taken basically the liquidity and stock charts and put them together so you can see how they behave in and around recession. See right here, it's like actually when liquidity is not super bad, they aren't necessarily super tied together. And here I'm using M2 as my measure of liquidity. Technically, there's a lot better and much tighter ways to define liquidity. But for this broad, longer term analysis that goes back decades, I'm using M2 because well, that's data that goes back decades. But you can see here that they tend to kind of fall apart roughly at the same period of time, and then also start to recover somewhat at the same period of time. So that's the thing is like if you really want to understand what's going to cause a stock market crash, you got to really understand liquidity, not the economy per se. And liquidity is an important part of the economy, but it's a leading part of the economy. So you can't look at the rest of the economy to figure out what's going to happen with liquidity. So here also I show rolling 3 year returns for the stock market and also rolling 3 year change of M2 going back over those decades, those recessionary periods. As I said before, it's like it isn't even necessarily super tightly correlated when you're not going into recession, but when you are going into recession, you'll see them drop together almost every time. And often there's recoveries together too. But like once you're outside the recession, you're kind of in these in between periods. There can be a lot of uncorrelated periods there. They're not tightly correlated really until you get there. And there are exceptions. Here you can see 2001 M2 stayed pretty stable, and stocks dropped a full ton. But I think that a lot of that had to do with valuation and speculation, things like that, tech bubble itself. And then also 2008, it's not a super clean correlation because partially because of how big they expanded the money supply, and um, due to the crash, it kind of like throws off the chart a little bit. But the recovery probably is due to that expansion of the money supply, but there is a bit of a lag in 2008, 2009. So like these two recessions, I will say it's a little bit weaker of a correlation for kind of very idiosyncratic reasons. That if you understand those recessions, it somewhat explains why those ones are a little bit different. But in general, like I said, it's like things are pretty well correlated. I mean, I can show you other, like I said, better measures of liquidity that show it even better. But M2 is one of the only measures of liquidity you're going to have going back to the 60s. So that is what it is. So that's my business cycle analysis tool. Now I still have a ton of other data I kind of want to zoom through to give you guys more of a picture, because this is, um, I mean, I think this analysis is really good. This stuff, but this is basically based off of one, two, three, four, five, six, seven, eight, nine, 10 pieces, 10 data points, like 10 specific data points at each of these moments in time, which is pretty good. But the point is, I can show you kind of the same stuff with multiples of that data point. So I've also showed you guys these charts in previous episodes before, but here I'll show you the green line is gross domestic product. So this is the thing. This is GDP growth. This is the thing we're kind of trying to model out. And here I'm showing like different pieces of GDP, specific personal consumption expenditures, durable goods, residential fixed investment, and then gross domestic fixed investment for equipment. And basically showing like those are very capital expensive portions of consumer portion that's very capital intensive, like durable goods. And then for businesses, it's like I said, residential plus fixed investment of equipment. Those are capital goods. People tend to buy those when the economy is going well. So you see that those things tend to fall off when the economy is going into tailspin. I have kind of two different ways of averaging them together, but you can see how well that actually leads GDP. So looking at those measures right now, zooming in on the kind of like the most recent few years here, as of Q2 data, we don't have the Q3 data because really it's going to show up only like a month or two now. But the point is, as of at least a couple months ago, this stuff is still in pretty good territory, still pretty positive territory. So the next several charts are going to kind of be very, very similar, where I'm going to be showing you basically a time series I put together of certain pieces of data and then how that compares to GDP growth. I have literally like a dozen of these. So here's another one. This one only goes back like a decade or so. It's basically the same one as the last one, but this one's real GDP data rather than just nominal GDP. Here's real gross domestic product, and here you can see those measures line with each other, and like doing it on those last couple of years as of Q2, relatively positive. Looking at another one, real GDP growth right here. Here I'm using total vehicle sales, total one family home sales, plus total personal consumption durable goods sales. Again, another way of thinking about kind of capital spending. But these ones are, instead of using the GDP reports themselves, we're just using the actual figures of sales, like the actual nominal figures of sales coming from the motor vehicles and housing urban development department data. And so here, these ones are much more volatile. These are monthly data sets. So here you can see we were relatively close to zero for a couple of years. This one really kind of paints that rolling recession kind of picture I was painting as well. We were negative in 2022 due to the high interest rates. Then we kind of recovered a bit in 2023. Then in the second, or in 2024, things kind of went kind of the zero range, but not in negative, not particularly in negative. And, we're not definitely not recessionary. Here you can see it tends to go very negative around recession. So just another one to kind of that picture. Here doing the same thing, but this one is with manufacturer new orders. So new orders for construction, new orders for non-defense capital goods, new orders for consumer durable goods, and very, very similar kind of methodologies, but using totally different data sets to paint basically the same picture. You can see that these ones tend to spend their time pretty close to zero unless they're going into recession. So once again, kind of in negative territory for the last couple of years, but not massively so, not recessionarily so. Moving on from that, doing the same thing, but with industrial productivity data. Industrial production data shows that we were, yeah, kind of in somewhat of negative territory for 23 and 24. Now back into somewhat positive territory for much of 2025. In fact, this is probably one of the more positive looking ones I would argue that I've seen. This one I actually created only in the last like month or so. So this one's a newer one that I know I didn't have previously. And I really like this one because a lot of these previous ones, you could argue, obviously, because this is one of the other things I want to talk about a little bit later, is that people are concerned about the independence of the Fed as well as of the various agencies that report this data because um, either you didn't trust the previous administration's appointees or the new administration has decided to throw out various people in those agencies to put in their own people in those agencies, and so maybe you don't trust those people. Like I said, I'm trying not to take political sides here. I just try to look at data and understand data. That's all I do. The point is me being a data person, I have always been somewhat skeptical of government data, even though I rely on government data to a significant degree. The point is, I always like to think about, well, what are other places I can get data that would corroborate the results? And I'll go into, like I said, some of those things a little bit later. So the point is, I like looking at a lot of these different data sets because they come from different places. Like a lot of these are different government places, but still they're different agencies with different people. And the truth is that when governments are making up data to a significant degree, then that means if you look at all the different data sets that are being made up, they won't actually end up agreeing with each other. They will end up contradicting each other if they are total bullshit. So that's the thing is that that's one of the reasons I like to do this because you might be saying like, oh well, if these are all basically the same story but with different data, what's the point of doing that? Well, that's one of the reasons I do this. That it kind of helps me look through and not just take one piece of data like the real GDP report and just assume that that's like the perfect representation of how the economy. Um, there are revisions to all this data. In fact, those revisions are a big part of the discussion of whether or not we trust this agency head versus that agency. That there were some very significant revisions to the jobs data, and now people are don't know if they can trust it. The truth is if you understood their methodologies and understood how the revisions work, then maybe you would understand that well, actually, there's logical reasons for why all those things. Again, we'll get into some of those details about the jobs data a little bit later once I finish going through this. Anyway, I said that all that because like I said, I added this new one here in the last month or so, and I really like this one because this one is very different from some of the other ones, which these other ones are basically using, like I said, leading capital goods, but from different data reports to try to show leading elements of the economy. Whereas this one is very different. It focuses much more specifically on the consumer, and it uses much more harder to fudge data points like the average hourly earnings of non-supervisory employees, the average weekly hours of non-supervisory employees, and the total population count. Like those are a little bit less fudgeable of number. And I basically here show you the same thing. Now, this one would basically be a proxy for like personal consumption expenditures, but here you can go GDP growth. In fact, this one you can see GDP growth tends to be higher than this one. One thing I'll point out here. But here, this like I said, this is like a growth of the per capita PCE spending. Here, in the last 5 years or so, we're weaker, gotten to a lower level in terms of rate of growth, but still relatively stable. It looks like it's stabilized at roughly around the start of 2024. It kind of looks like around the point where it started to stabilize from this big decline here. But yeah, I really like this one. This one was a new one that I put together only, like I said, within the last month or so, and I was like, ooh, this is a really good one because it uses, I think, a lot less complex data, a lot more easy to understand data to say, and also you can easy to understand like how this relates to your life. Like this is basically like the average per person um, consumption spending available that's going in here. Like I said, per person. It doesn't. This isn't like a per employee. This is it actually takes into account the amount of people that each employee has to take care of. So like the amount of people in your household. It's a per capita consumption spending measure. Um, and the reason why that's valuable too is because that also takes into account the changes in population and therefore like changes in immigration policy. So it kind of looks through some of that fuzziness of the data this year. That, by the way, that's one of the things I think that is throwing people off in terms of their understanding of the jobs data, inflation data, all of the data. The fact that we've had our huge changes in immigration policy that has some negative effects on the economy, but it also makes certain aspects of the economy look worse than they otherwise would be. So while we've had some declines in certain employment data, some of it may not be bad things as you might think if you take some of those things into account. So anyway, moving on from that, here also I am doing the same thing as a lot of those previous series. Like I said, using the kind of leading parts of the economy, but this one is with employment data. This one's actually using employment level of construction workers, employment level of production occupation, employment level of transportation occupation, and then looking at that on a rate of change basis relative to here you can see how well those two actually go in line with each other as well. And as you can see in the last like few years, pretty kind of negative territory ever since 2023 began, like 23 and 24. We've been kind of hovering in this kind of negative range, but not dropping off a cliff kind of range, right? Like the recessions show it going down into like -2%, at least -1, -2, -3, down here -10 kind of percent. But over here, we're seeing like the worst -3, but most of it like -1, -1, -2, -1, negative half. So we are in negative territory on this kind of employment measure here, you see, but it isn't necessarily like super, super recessionary. It's just been really dragging negative for the last couple of years. But like I said, it would be great if we could see this turn around. This is definitely one of those important measures. Employment is definitely one of those key parts. So um, a lot of the other ones are showing pretty good territory. This is definitely one of the more negative ones because a lot of them show them dragging like this. But as I said before, it's like it doesn't have to get super negative for this necessarily. So this one's definitely I would say a more questionable. Then moving on from that, that's the end of those kind of time series of me kind of trying to proxy GDP growth through other measures essentially. But here, actually looking at the unemployment rates across different types of professions. We have management, business, and financial operations, relatively stable. Professional related operations uh, on an uptrend ever since 2022, but still somewhat stable. But it's still definitely kind of tipping upward a little bit. Service occupations relatively stable. Sales and related relatively stable, but maybe on a slight uptrend. Office and administrative relatively stable. Construction and extraction occupations pretty stable. Here you can see it zigzags a lot. We're on a little bit of a downswing from the zigzags. Hopefully, it doesn't too much in coming months. Probably during winter months. That's what these tend to be is those winter months. Um, Production, a little bit of an uptrend there, but relatively stable. And then transportation, definitely a little bit of an uptrend there. So yeah, you can see it's like if you kind of break it down by like different types of work rather than the different parts of the economy, you kind of like look at different aspects of it. And here you can see within that, most of these are very stable. So how is it that we're getting a stronger drop off in employment by different areas of the economy, but then different production types are stable? What that means is that what you're getting is kind of like a whole scale down of employment across company rather than just in specific departments. That's actually sort of what that would imply. That like by departments, the rate of change of employment isn't shifting too dramatically. But certain companies are having to scale down their employment dramatic, is what that sounds like. If I had to kind of put these two data points together and say, like, well, how do those two pieces fit? That would sort of be my answer to that. So moving on from that, I also want to show this is employment within government work, which is a data series I've been kind of tracking all year. Obviously, I started tracking it when they were doing the Doge program, which obviously came to a close, but I'm still kind of tracking it. One, because, for example, a lot of the buyout contracts that federal employees took during the Doge program are actually starting to come out to a close here. I've heard some articles talking about that. So those people that were took the buyouts but were still technically on the rolls are actually going to be starting to come off of those federal rolls here. Either they already started or it's starting here somewhat soon. And then I'm still kind of tracking those changes in time. And then one thing I kind of want to point out about that, which I think I pointed out on a previous show, is that we've seen this little dip down here in front of it. We've seen this little dip down here in federal employment, which is substantial. And all of these are showing as a percentage of the population. What those ratios are. So we saw a little bit of a dip down in federal employment over since the start of the year for sure. But what we have seen is that state employment has not particularly gone down. In fact, state employment has increased throughout the year, not particularly to make up for federal employment, but still increased. And then the green line is social assistance work, which I look at as essentially like um, outsourced government work. So it's sort of like a proxy for other places that those people could work. And what you'll see is at the same time we got the dip down in federal employees, we got a bump up in social assistance work. So it literally did function as a proxy for that. And I pointed this out when the Doge program was going on, because a lot of people were saying, oh well, that all these programs that are being canceled, all the people that were being served with them, they're not going to be able to get their services. And I was like, well, I mean, there are other entities like social assistance companies that do provide those services. So it's going to cause disruption for the people needing those services, certainly, but that doesn't necessarily mean that like you can't get those resources. It means maybe you're going to have to think outside the box and ask around to figure out where another source for those resources is in the private markets rather than through public programs. It feels weird calling it private, even though it's social. That's still kind of public funded, like I said. But either way, point is that trend may continue. Like I said, with the fact that those rollovers of the government roles are going to start to happen here in this month and the next couple of months, that little bump up may continue going forward. So paying attention to that, and then also what with the government shutdown, they're supposedly going to be doing some significant layoffs then too. So that's another reason maybe paying attention to the time period. But either way, I will say that for federal employment, that is not a huge portion of the population. That is 0.85%, 85 basis points of 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 the population is employed by the federal government. Less than 1%. So looking at some other employment measures, here is the kind of leading indicators for employment. This is initial claims, and then also initial claims as a percentage of the civilian labor force. I always like to look at things on like percentage normalized basis. That's just the smart way to look at economic statistics. No, it doesn't necessarily make a difference sometimes. So I'll take COVID out of the picture because that really throws things off. Take COVID out of the picture, you can see right here how things look in general. Prior to COVID, we had been at very, very low levels for sure. This, what is that, 12, 13 basis points in terms of that percentage level. And you can see it tends to, when it starts to move upward, really spike upward as you go into recession. So zooming in then again on the last couple of years here, uh, 3 years, we have been on a bit of an uptrend, but that uptrend technically had its highest point in June 2023. Technically, we haven't really reached the same high point since then, though on kind of like an average basis, we're still uptrending a little bit here. And then we have been uptrending since the start of the year as well, but that's still not really at the same peak level. So it's like uptrend, but not a very, very fast uptrend. And, we are at a very low level. As I said here, this is 13 basis points, and that 13 basis points is basically that same roughly low that we were at pre-COVID. So we're at kind of the same levels as we were pre-COVID, even though we are uptrending. So not not dramatically worried about initial claims, but this is the earliest place where you stress labor markets, generally speaking. Then the next portion is the continued claims, which is basically like 1 week later. Like these are people at their first week of trying to claim unemployment, and then these are the people that basically are continuing a week later. They are now insured, unemployed, and have remained in the program, which tends to be a much larger portion of the population. About 1.1% of the population is where we're currently at. And then if I out, so here it's easier to see with COVID, it was about 1%. It was a little bit less than 1%. We were at like pre-COVID, we were hovering around 1% or so, maybe a little bit less so, but it had been downtrend and downtrend. So then we said that most recent couple of years here, uptrending over the last 3 years, but you can see the bulk of that uptrend happened in 2023. And then we've still uptrended since 2023, pretty continuously, but it's a very slow, steady uptrend, which is very different from a lot of these usual uptrends. Usually, when it starts to move up, it starts to move up very, very quickly. So it's very interesting to watch. It's very different from how this kind of data has generally behaved historically, which is why a lot of people have very differing opinions about it. Like will say that, oh, that means we're definitely uptrending into unemployment. And other people say, no, 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 it's just normalizing. And honestly, it's like both arguments are very plausible. So that's why it's like his employment's a very tricky thing right now to understand, definitely. But watching it, but really, I want to see this kind of rate of change again. If we get into this type of rate of change again, I'll start to worry again. Um, but yeah. But anyway, moving on from that, we'll look at inflation data, a bunch of different inflation data. All right, take a little bit of a breather. Copy. So looking at inflation now, getting back to the little diversion I said earlier about tariffs, how I will constantly make the case that I think it's wrong to think of tariffs as inflationary, though I understand why people confuse that, because tariffs do increase prices. And so people think of inflation as price increase, and therefore they think, oh, if a tariff increases a price, therefore it's inflationary. But in my opinion, that is just an incorrect way to understand inflation, and therefore it's a misunderstanding of what tariffs actually are. Because like if you talk to traditional like general traditional economic understanding, people will say, okay, well, if you're thinking about inflation, how do you bring down inflation? Right? We raise interest rates to bring down inflation. But one of the other things you can do to bring down inflation is raise taxes, because in the same way that raising interest rates causes people to park their money in order to earn the interest rates, which means it's not being spent in the economy, you're essentially taking money out of the consumer economy, parking it in capital markets. That's what raising interest rates does. But if you tax, if you raise taxes, you're also pulling money away from the consumption market by bringing it into the public government hand. So that is a disinflationary effect to increase taxes. Tariffs are taxes. Okay, like there's no doubt about that. That's what they are a tax. So it's silly to think that tariffs, which are taxes, are inflationary when taxes are disinflationary by definition. Now, like I said, they do increase prices. So they increase the prices of those goods, but that's not what inflation is. And now when we talk about inflation and when we talk about how interest rates lowers inflation and how taxes lower inflation, when we say that, we're talking about CPI, the Consumer Price Index, or PCE, the Personal Consumption Expenditures Price Index, or the GDP Price Deflator Index, which is a broad base increase in prices across the whole economy. That is what inflation is, generally speaking. So that's what I mean when I say that that is not going to be increased by tariffs. However, now I had also said earlier that assumes that the money supply is not increasing at the same time. We're talking about kind of like a fixed amount of money in the system. Money has to move from one place to another. You increase prices at the port, so that because of tariffs, and that means there's less money to be spent on other things, which means that those prices have to come down, or you have to sell less of those goods, one or the other. But if the money supply is increasing at the same time, which in our credit-based system is generally always the case, and it is in fact the case right now, then there would be more money to theoretically go spend both on the higher prices of the tariffs and on the same prices and volumes of the other stuff you wanted to spend. But the point is you're going to see the increase in the price on the tariff goods, but that does not mean that that's the cause of the inflation. The cause of the inflation is the other money that was then printed into existence by either a private bank or by the Federal Reserve System in order for it to fund its own financing for those prices to then go up. Okay, so like I'm explaining this very carefully, very slowly in high detail. You can go ahead and try to explain that to other people if you want, if you hear them with this making the same misrepresentation. And I'm going to show you the goods increases, so you can even see like there you can see the tariff price increases on some of these charts. But what you're not going to see it is on some of the other broad-based charts. And the thing I'm going to argue is that the reason why we still have our issues with that is because we still have our budget deficit generally. Pull that chart up. Did I? So let me. Here's our budget deficit right now. Here's it on a monthly basis, and then the red line shows it on a quarterly basis, annualized. So we currently have a budget of, as of Q2, on a trailing 12-month basis of 6.1% of GDP. Now, I think for Q3, that's actually probably going to be down to like 5.5% due to the tariff revenues, um, maybe like 5.75, 5.5%, something like that. So it is going to be a little bit lower than that. But the point is 5.5%. And prior to COVID, literally just prior to COVID, we were at about 5%. We had been kind of like 4.5 to 5% for like a year prior to that, and then that had been uptrending for time previously to that. You can see that as a percentage of GDP, we've been just increasing, increasing, increasing on a general trend basis. So that's, in my opinion, the cause of the inflation is that this is finally really started to inflect to an upward area and not ever go back down to the lower level. But that's a whole complicated other discussion. It's also one of the reasons I'm such a big gold bull and all that. So, but anyway, looking at inflation, the actual inflation measures here, the broad-based inflation measures. Here's the CPI. This is the headline information measure. PCE, this is the broad PCE, and then there's also the core PCE, which is the one that the Fed likes to talk about, and then I also have core CPI. So both CPI and PCE, and then the core of each of those measures, you can see as they are. All four of them are kind of a higher level than they were on the trend pre-COVID. All four of them are like 0.5% to 1.5% higher than wherever the kind of lower level was, and all four of them have kind of largely bottomed on that trend. Like, well, not all four of them. I'd say 3 out of 4 of them have kind of bottomed on that trend about a year to 2 years ago in 2023 into 2024, which is kind of that same time frame as I was talking about that we were kind of theoretically going through our rolling recession, which if you remember when I was showing you on the kind of business cycle analysis, inflation doesn't ever really come down to its low level below trend unless you go into recession. So we got down to that low level of trend for these measures of inflation because we were going into that rolling recession, but we didn't ever go into a super full recession. So that's why we haven't gotten numbers down all the way to their pre-COVID levels. They, but like I said, that's only for 3 out of 4 of them. Technically, there's this one, the core CPI, which really only bottomed in was that April or May of this year, and then started to move upward, which is one of the things that we do. And also here you can see technically this one, which is the headline CPI, also bottomed April, I believe, but we got almost to the same level in mid 2024. So I would argue that that kind of hit its bottom of its trend really more like mid 2024. But then core one kind of depends on the line, the exact spot where you would argue the bottom here, or is so moving on from that, then there's also the producer price index, which is the kind of an input cost for corporations. And here I show it on different stages of development, which I think is an interesting way to think of these because it kind of shows like the different parts of the production process, like where the prices are increasing in those parts of the production process. Gives you a hint of kind of like where the economy is headed. Because like if the stage one and stage two parts of the production are starting to inflect to higher inflation rates than the stage three and stage four and final demand levels, and that kind of implies that the economy is starting to inflect upward in terms of GDP growth and inflation. Kind of implies both to a certain extent. But then likewise, you kind of roll over. You can see that like the blue and the green tends to swing to the highest end both directions in the curve. So with that, I mean, the blue and the green, the blue is moving upward, has definitely kind of been moving upward since kind of mid last year. Then the green's kind of been zigzagging since the kind of like mid year. So green doesn't look so great, but blue actually sort of looks like maybe it's on a little bit of a trend. So we'll have to kind of like with that. I've been noting that really for all year, but we'll have to continue to note that, see if that trend continues to go, because that's actually sort of a positive sign for economic growth, generally speaking. But I want to see it move into the stage two. That's the thing. Is I want to see this start to move up above those little curve bumps there at the end. I want to see it kind of, you know, break out, so to speak. So then also looking at the PCE alone, but in very specific subcategories. Here I have durable goods, non-durable goods, services, which is kind of like different categories of the economy. And I want to show this one because here's the durable goods category. This is, as I was saying before, in some select sections of CPI or inflation measures, you can see the tariffs very clearly. And this is where you can see the tariffs very clearly. Like here, for example, you can see that it was negative. In fact, you can see that it was generally negative, right? The durable goods PCE inflation measure was normally about negative 1 to 2%, literally back to the mid 90s, and that's globalization. By the way, that's literally what that is. Mid 90s is when China joined the WTO, and so that's when we started having our trade deficit with China become much larger and much more substantial as we started to import much more things from China. And this is the effect of it, literally on a chart. This is the benefit we got from our trade with China, is that durable goods inflation was literally negative for decades. This was cheap durable goods from China for Americans, is what this is. Now, obviously, it's not positive for the companies that want to sell those similar goods and are competitors with those other companies. So like I said, it's positive for some people, negative for other people. Positive for the people that were buying the goods, but it's negative for people who compete with that. So that's the kind of the other side of the argument. That's what it is. And then here you can see, boom, we broke up into positive territory above trend outside of the inflationary spike period post COVID, and that is literally the tariffs, the chart itself. And non-durable goods, well, it's a little bit more flat, kind of inflecting a little bit up in the last couple of months. It's kind of been really zigzagging 2 years or so. So that's a little bit more flatter on that. But here you would theoretically expect to see some tariffs as well, but nonetheless, there's less imports in the category than there is in the other. And then services, you don't really see a huge inflection upward in general. But here, I had already kind of pointed out in the previous charts how um, uh, I had pointed out previously how on all these measures were like still like 1 percentage point or so on average above the pre-COVID trend level. But if you uh, look at this one in particular, the services one, the PCE services one, this one we are way up there. The pre-COVID trend level was about 2.5% or so. You can see for like the previous decade prior to COVID, it was about 2.5% or so, and we're hovering at like what is that 3.5 4%? Oh, 3.6 right now. So okay, still about 1%, but very solidly above trend. And this is a very stable measure. This one's a lot more stable than a lot of these other measures. So this is one of those ones I point to make I have been pointing to for literally like 2 to 3 years at this point, that make the argument for why you should not assume that inflation is gonna durably stay down at 2% anymore, ever, really, like unless we do significant changes, unless we improve our deficit dramatically or have a significant recession. One or the other or both is literally required, in my opinion, in order to get this number right here down to so yeah. And then like I said, that was the argument before tariffs. So like I said, like yes, you can see tariffs in the data to a certain extent, but that's really a small portion of the story. The story has more to do with the deficit, which, I mean, tariffs are part of the deficit story to a certain extent as well. But anyway, market-based measures. I also have PCE market-based and then core PCE market-based, which I mean they're very similar. Really, it's just kind of trying to replace certain like service-based, survey-based measures with more alive measures, which gives you a little bit of a better understanding in real time of the changes. And likewise, the core PCE using market-based measures has been remarkably flat for like 2 years at this point. Remarkably flat. So, and this measure, it was stabilized at what was that, like 1.5% on average for the decade pre-COVID. That was like 1.5% on average. Here, and it's a 2.5. So there you go. About 1% higher than the previous trend. Moving on, I also have a core PCE minus housing. So this is that super core measure, the super core measure that the Fed was talking about for so much, which you can see hovered around 2 to 2.25. I say 2.25. I would say it was kind of like the pre-COVID average. And then this one is now currently at like 3.25. And really, it dropped down from like 3.5, 3.75 in the last 6 months or so. It dropped down a little bit, really. But it was also somewhat flat for a year and a half prior to that. We'll drop down. So, yeah, very lacking in the downward trend in inflation. But hey, we cut interest rates, didn't we? Didn't we, guys? We cut our interest rates. uh, we'll get into that. there's we'll get into that. Like I said, like I did put the Fed as part of the trial too, so I want to talk about those really that in terms of like what are we expecting with the interest rates, what's going to happen with them, in terms of like where how much interest rate cuts are we going to get from the Fed, what's that going to do to the long end of the curve versus the short end of the curve, and what does that imply for GDP growth as well as for inflation. Um, there, yeah, it's a mixed pack. It's a mixed package. Frankly, we're between a rock and a hard place in certain things. Like essentially, it looks like they've opted for a higher inflationary policy. That's true, but like I said, in my opinion, that inflation has nothing to do with the tariffs. It really has to do with budget deficits and Fed and stuff like that. Frankly, but they are opting for a higher inflationary policy. That does seem to be the case. But the point is they're opting for a higher inflationary policy because they're also trying to juice higher growth policy. They're hoping to get both. That's the thing, which they often are quite correlated. So that's the thing is that might work out, but it might also not work out because they're not always correlated. So it's like one of those things where it's like we'll see how well it works out. They tried cutting their way out of the debt problem at the start of the year with the Doge program. That very quickly got shown that it wasn't going to work, and so now the new plan is to try to grow the way out of the program for the next probably couple of years or so. We'll see. We'll see how well that works. That has worked decently well throughout history at various times, but it's something that you don't have full control over. So it's one of those things where it's like, well, maybe it'll work. It's somewhat of a dice roll, and if that doesn't work, the final solution to the problem at that point is printing your way out. You know? So that's those are the stereotypical solutions to the debt problem that we're dealing with, which is inflation and inflation and print your way out and grow your way out plus print your way out both include inflation. Those are both inflationary methods. The cut your way out is the non-inflation, but the cut your way out is also the recessionary. So that's the thing. Like you have to take your good with your bad. It's like the solutions to these problems are always have some good and some bad with them. Like you might be able to get no inflation, but then you're probably gonna have recession. And then the other alternative is, well, you might get a decent amount of inflation, but you might actually get some job growth out of it too. So it's like that's kind of like the rock and the hard place kind of situation that our economy is facing. Anyway, that's like I said, I was looking at the core PCE measure, but the other parts of the chart are actually showing those housing measures. Basically, have three different housing measures in CPI right here. All three of these are the survey-based measures, so they're not like real-time prices. That's one thing to keep in mind. So a lot of people say, well, that's useless. It doesn't tell you what like the actual house prices or rent changes are. But it's like, well, this is how people who own the properties feel about it, though. So that's the thing is like it's still useful information, even if it's survey based. You just have to understand who really is answering these surveys. Like only think about it from those people's perspective. So these are real estate capital owners' perspective on inflation, right? So that's one thing to kind of keep in mind, or I should say, perspective capital. So nonetheless, all of those measures are all still pretty up there, 3 to 4%. That basically means that that's what they feel rent growth should probably be at, like 3 to 4%. Real rent growth isn't actually at those levels. It's at like 0 to 2%, depending on where you're looking and like how you're averaging stuff like that. We were in kind of negative territories for various, depending, like I said, depending on what averages you're looking at, and what areas you're looking at. But we're maybe potentially even starting to improve on that front. But the point is, in terms of this, and this is also the stuff that goes into a lot of these CPI measures, which still goes into a lot of people's thinking about what inflation is going to be. These are still quite elevated. And then, like I said, while this measure here at the top doesn't even have housing in it, and it's quite elevated. So that doesn't even have those surveys in there at all. It's very elevated. So anyway, uh, technically this is kind of a some of the other charts. So that's all the inflation measures. That's all that. Let me get rid of tabs up here with all the data we've looked at. Hour and 15 minutes into the stream. It's during the workday, so not too surprising that not a lot of viewers or chatters, but hope you guys will enjoy it on the replay nonetheless. If you are watching live on the replay, I would appreciate a like. Really, really helps the stream if you can like it. Also, subscribe if you haven't already. join the free Discord. The link is in the description below, but also the pinned comment in the chat. And also, if you are so inclined, feel free to perhaps donate to the channel. There's a PayPal link in the description below, also a Patreon as well. It would be really, really appreciated. So yeah, please support the channel in whatever ways you can. So I wanted to talk a little bit about liquidity. Because as I said before, really that's the thing that matters more to stock than the economy itself, really. Um, and there's some things to talk about in that regard, which is to say, like, this is a measure of liquidity I've become pretty fond of, and I try to track somewhat regularly on a weekly basis, looking at the weekly averages of it. So I change the periodicity you're looking at. Very noisy chart. Bleed it out, but I could show it on the daily, which is very, very chaotic. But this measure right here, is a measure of funding costs for banks. The SOFR rate, which is secured overnight finance rate, minus the Fed funds. And so the Fed funds rate is the rate at which banks can borrow money overnight from the Fed. If they need a 1 day loan, they need a 1 day loan, and they need it from the secure borrower, the Fed. They can acquire those funds from the Fed at a certain rate. And then the SOFR rate is kind of a similar thing, but between major banking institutions, it's an overnight funding rate between them. So this gives you an idea of basically the cost of funding to get money from another major commercial bank versus getting it from the Fed, both on an overnight basis. And so this is, like I said, a measure of liquidity. Basically, it tells you how expensive a dollar is for 1 day. Like how expensive is it to borrow a dollar for 1 day for members of the financial system, like the actual financial institutions themselves. So like people theoretically have like the best availability of credit in general. And so the higher it is, the less liquid things are, because that means it's more expensive. The lower it is, the more liquid it is. And it doesn't, unfortunately, the data only goes back to 2018 because SOFR is very new. So unfortunately, there isn't a ton of data for this. I would love to show you like prior to previous recessions and stuff like that what it looked like, but we don't have that information, unfortunately. But it's still a logically sound thing to take into account. And here you can see we were actually going through some serious liquidity strains prior to COVID. The fall of 2019, the kind of major dip we had in the market during that time frame was in many ways actually um, responsive to these difficulties in the repo market that we were having. That was basically what was going on here this the latter half of 2019. Stumbling a little bit before then we went into kind of the latter stage, 2020, a little bit of a repo market flux. So anyway, the point is here in here when we had the large money printing after COVID, you can see money was very available. There was no liquidity concerns for a couple of years. So I've been watching this measure in general, and you can see kind of like on average, it's been getting more and more and more positive on average. So, like I said, one reason I like to look at it on a kind of a rolling averaging basis because it can change the way you get daily spikes are kind of oh so high. We've had some higher spikes, but they're more common over here, which is why the average starts to widen out a little bit. Weekly average, you can see last week wasn't as bad as prior to that, but still pretty bad. But then one week was really bad in 2024, but then it became better again. So you see, is like kind of depends on like how you're looking at it. Monthly average, it really starts to make the most recent month really bad. Um, Compared to the max, the worst month since 2019. So we did first month as well. So I'm watching this. This is just basically a measure of strain within the financial system. And over the month of September, it was particularly bad. That's just, I guess, the way to set it up. So it's one thing I'm looking at. There are other measures of liquidity I like to watch, which is here's a high yield spread for that takes into account certain kind of bankruptcy conditions and spread against the 5 year and 2 year treasury average of them because that's kind of like typical maturity for higher yield debt. Um, Kind of like shorter term time frame, we had relatively low spreads. We had a big spike up there during the April period. Was one thing to kind of look at to say, look, how bad things are going to get. Um, you know, this is information we do have for a few previous recessions. So obviously, like really, it's when the spread gets over like 4 or 5%. That's really when you really want to start paying attention. And we've had some periods of that too, but really we haven't here. So on this measure, things don't look as bad. If this is not an overnight kind of liquidity measure, this is much more of a couple year based liquidity measure. So really it's showing that the liquidity drain seems to be on the very shorter end of the things rather than on a little bit more the longer end of things. But there are other ways to think about liquidity has been somewhat improving all year on this is the dollar index, so this is the foreign exchange value of the dollar, and really kind of like a couple different versions of it showing, but the inflation adjusted, the nominal version of it, they're kind of very similar. Zooming in on that, you can see that frankly, since the start of the year, we've actually been dropping, and that's actually a good thing in terms of liquidity. A lot of people, there's been a lot of headlines talking about this as well. Like there's headlines being like dollar drops to the lowest level in 10 to 15 years, and it kind of spells it like that's a bad thing, which I think is kind of funny because it shows that the people writing those articles don't even know what this is. It's like you hear dollar dropping, that sounds bad, but like the American consumer would think that that's like inflation. You're thinking you're like, oh, that's like the purchasing power of my dollar. The purchasing power of my dollar is dropping. Like, well, no, that's not really what that means. This is a foreign exchange value. So it's like if you're planning to go to Europe or Asia and spend all your money there, then yes, you probably care that the dollar exchange value drop. But if you care about being employed by a company that does business overseas at all, then you would actually like this because that actually means that you're less likely to become unemployed because now there's more liquidity in foreign markets, which is why I brought this up in terms of the liquidity discussion, because this has actually been an improvement in liquidity all year. Um, and it's actually run contrary to the tariffs. A lot of people were expecting that when the tariffs were raised, that the dollar value was going to go up to essentially counteract, because basically they move contrary to each other. If a tariff gets raised, you would expect the dollar to become stronger, which basically completely cancels out the effect of the tariff. But what we've actually had was the reversal of that. The dollar has gotten weaker instead, which funnily enough is actually more like a doubling of the effect of the tariff. It's actually more like exacerbated the effect of the tariff. But what that does is that does both improve things competitively for American businesses, and like I said, it supplies liquidity to foreign financial markets because um, the this is a foreign exchange value, like I said, and foreigners use our dollars for commerce. So this means that it's now cheaper for foreigners to get a hold of those dollars and use them for their commerce. Okay? Our position as reserve currency is stronger. Your position as the reserve currency is stronger when this value is lower than when it's higher. So that's the thing. Like people have been saying, oh, the tariffs is threatening our position as the reserve currency. Like, well, sort of, but then we also had a drop in the dollar, which basically improved our position as a reserve currency. And like I said, like our position as a reserve currency is changing, but I wouldn't call it threatened. It's just that it's changing. We are becoming less attractive as the reserve asset globally, but we are just as, I would say, attractive as the reserve currency. I would say the thing is you have to sort of understand the difference between a currency and an asset, and you have to realize that for many decades, basically the whole duration of this chart back to the 70s, the dollar has been used both, and what we are being used as the reserve asset a lot less for the next decades, and that's in line with those higher inflation expectations, like I was talking about. Those higher inflation expectations would make the dollars less attractive relative to, for example, gold, which there's also been lots of reports in the last couple about the fact that gold, due to both central bank buying and the appreciation of the price itself, gold is now actually the largest reserve asset on global central bank balance sheets. There's now a higher value of gold on central bank balance sheets globally than there is U.S. Treasury. Not by a lot. They're basically approximately equal. I think they're like it's like 22, 23% or something. So between the two of them, it's like 45 to 50% or something like that. Um, but the point is people are now saying, okay, well, I don't want to hold dollars for as a long-term asset. I don't think I'm going to earn very good interest rates dollar assets because when they say asset, they mean treasury. And when they say currency, they mean literal dollar, right? That's the thing is people don't hold the dollars, they hold the treasury. That's the reserve asset. So treasuries are no longer a very attractive reserve asset. People, central banks would rather own gold than own treasuries. However, they still want to own dollars. You see what I'm saying? They just don't want to own the treasury, but they still want to own the dollar. But they only want to own enough dollars to do their business because otherwise they're not earning dollars. So that's the dynamic. That's the dynamic. It's not that we're losing our position as a reserve currency. It's that we have massively weakened our position as a reserve asset, and we were serving both of those roles. Now we're going to be really serving like one and a half of those. That's my picture as I would. And like I said, in many ways, tariffs are a catalyst for causing those things to continue to happen. But in some ways, they don't necessarily threaten that asset or that currency position. In some ways, they kind of reinforce the reserve. Like I said, like tariffs are a complicated topic because they really do have a very complicated mixture of positive and negative effects. It's like I'm not particularly pro tariff, and that's the thing is like I feel like when I explain these things, I kind of make it makes me come off like I'm like super pro tariff or something. But it's like I would not have put tariffs on. Like that's not what I would have done if I had been elected president and I was doing my plan to fix our economy. I would not have used tariff. That wouldn't have been my tool. But I understand how they can be used as a tool in combination with other things to do certain. So that's the thing where it's like I think I have like a sort of a middling understanding on it, where it's like I'm willing to try to not be super negative on them, even though I'm not particularly in favor of them. But anyway, so that's the currency discussion and liquidity discussion. The some of it I'm kind of pointing out is that short term liquidity is pretty bad, but long term liquidity doesn't seem to be an issue. But short term liquidity is the thing that kind of causes strain in the market. So it's very possible that that these concerns in the SOFR markets, that as this starts to become alleviated, that maybe we could get some short term volatility in markets. Very possible, which could be foreshadowed both by actual volatility, like the um, forecasted volatility, the implied volatility index is, but also the move index, which is bond market volatility. Um, I would say pay closer attention to that as well. Which this has been on a little bit of a downtrend. So that's good. That's a very good sign that this is downtrending. When this is uptrending, it kind of makes it less concerning. But this could spike up pretty quickly. This is an implied measure, which means it's a pricing measure. So if it's going down, that means people are pricing it too low, which is good if they're right. But it also means that they could be caught off sides because they're pricing things to a low expectation. And then maybe rates change more dramatically than they're expecting, causing this to zip up quickly. And if this zipped up quickly, this would zip up quickly, which would cause this to pick up probably. So that's all I'm pointing out. That there's some short term strain in liquidity markets that maybe be concerned about. So moving on from that, there is let's talk. We're pretty close to the end of the show, I'd say. Maybe a few more things I want to talk about, and then maybe we'll talk a little bit about some portfolio stuff, maybe, but maybe not. We've been talking for a while, but so there's been all the concerns about with the like I said, there's the change in certain data agency heads. Some data agency heads got replaced by the new administration. Some people are concerned about that. Some people think that the data was really bad, like jobs data in particular, for example. People have been very concerned about kind of revisions in the jobs data that we've seen over the last couple of years, which is fair. We have actually seen some very dramatic revisions in the job data. So I wanted to kind of like show this. Like this is the jobs numbers that we're talking. All employees, total non-farm payrolls, what we'll call it NFP. This is the measure people are talking about when they're generally referring to job. Okay, so this is what I want to talk about. Now, when they report it, people are generally reporting this is the total number here, total number 159 thousand, so 159 million, 160 million or so jobs in the United States reported. But when they report it monthly, they're reporting the monthly change. So they're reporting how many thousands changed per month. And if you zoom in on this, Let's go pre-COVID because COVID always has a big spike in the data that makes it hard to look at. So we always want to kind of like go pre-COVID to look at it. Here's what the jobs data look like pre-COVID. And you can see if we even zoom in more specifically on just the kind of 10 years pre-COVID, 2009. Here you can see that on average, on a monthly basis, we would get anywhere between like below 100,000 jobs to maybe more than 300,000 jobs, but probably averaging like 200,000 jobs or so. I don't know exactly what it was, but like this period right here probably averaged like 200,000 jobs per month. That's per month coming in. That's pretty awesome. So you can get an idea of that. Now going over to last 5 years, last 3 years, here you can see we in 2022 we also had kind of like 200,000 jobs on average or so, and then 2023 it started dropping down to more like 150,000 jobs or so on average. In 2024 it was kind of dropping down. We had some higher months, lower months, but it was kind of even getting closer to like 150 late 2024, even lower. So over 2024 in general, it might have been like 100, 125 or something. So you can see what I'm pointing out here is the downtrend. We were on a nice solid downtrend that if you had kind of made a guess at the end of 2024 without knowing anything about policy changes or the administration, if you had said, okay, well, what's the job numbers likely going to be on average for 2025? It might have been reasonable to guess 100,000 to 75,000, 75,000 to 100,000 on average for the year. Which, I mean, go to quarterly average. Period. Gonna aggregate. Oh, it is gonna aggregate if I do it quarterly. Never mind, I can't do that. Never mind. I can't really show you what I wanted to show you with this graphic. But the point is, either way, you can see the downward trend. So then here, ever since 2025, we do have 100,000 average up till April, and April hits, which is when we have the tariffs, and then now we have even weaker numbers here. So people have been pointing out to this and saying, okay, is the job market really falling off a cliff? Because job growth tends to stop before unemployment spikes. So that's why we want to pay attention. Now, then there's also then we had first we had the replacement of the head of the Bureau of Labor Statistics with the new administration person, which caused a big consternation about it because they were saying that the person was being biased against the job numbers, and they were saying that the job provisions that we were getting, because these numbers are reported, but then they tend to be corrected twice over like the next 3 to 4 months, and those revisions. Trump was saying that were not making him look good, which didn't actually really make a lot of sense if you actually looked at like when the revisions occurred, like what the revisions actually happened and were. There were plenty of revisions that made him look good, as well as some that made him look bad. And then there were some that made Biden look good, and others that made him look bad in that same period that he was kind of about. So it's kind of one of those things where it's like it didn't really make whole lot of sense to be honest. Like to be honest, I don't really see why he felt like he was being unfairly treated necessarily. But either way, he was complaining about the revisions. The revisions were substantial. They were substantial in terms of like as a percentage of what these numbers were. They were substantial enough to be like, whoa, what's going on there? And it had been that way for like the last 2 or 3 years. And then after we did that, because I'm talking about, like I said, those revisions to the monthly number that we get like 2 to 3 months later. But then we also get a third big revision once a year to this data that happens in the preceding year after that. And we got that revision like a month after the new head took over the Bureau of Labor Statistics. And then that revision revised down the job growth of 2024 very dramatically because it used to be showing much higher numbers for 2024 previously, and then that got revised down. Like it was literally like 40% of the job growth from 2024 got revised down. So a huge, huge, huge percentage of job growth got revised down. And now, so that makes the downtrend look even more substantial. And so people are pointing this and saying, okay, well, how much of this is the tariffs' fault? Because it does look like it sort of got worse when the tariffs got put in place. How much of this is the revisions or just the overall general downtrend? Because there's definitely a substantial downtrend here ever since COVID. Like there's no doubt about that. That like going back for 3 years, very consistently downtrending. You take like a 3 month average of this, and it would be a nice consistent downtrend. But then also, this is the thing I think people are tending to miss in terms of the revision is that if you revise down the numbers from last year to 40% or so, and then also at the start of the year, we stopped bringing in a significant amount of employment from immigration, which immigrants often get jobs relatively quickly relative to unemployed in the United States. That was going to be filling in a significant amount of the jobs. Then you would have expected to see an even bigger drop off in job growth at the start of 2025 due to that. So I bring that up because I think a lot of people are completely missing that fact that if the job growth was averaging about 100 to 125,000 on average through 2024, and on average we were bringing in like 50 to 75,000 immigrants per month, which is approximately on average how much we're bringing in, then it actually means that the job growth in 2024 was more like 50 to 75,000 per month, which means that the numbers that we're seeing in 2025 are actually kind of in line with the numbers from 2024. Now, like I said, that doesn't show it on this graph right here, but I do bring up some other graphs to kind of show what I'm talking about with that. This is kind of taking that same thing, that total non-farm employment growth, and then going back to that period, like I said, pre-COVID here. And so you can see that's that same 200 to 300, 200,000 or so that we were looking at on the other chart here. But then also I show the population growth, the general population growth. This is just the total U.S. population growth. And you can see the population growth itself is also about 200,000 or so. It started to slow down a little bit in 2016, 2017, 2018, 2019, 2020. But you can see like that itself was about 200,000, which shows that like, that's one of the reasons why this was a stabilizing number, is that it filled in with the population growth, approximately speaking. But that population growth is an estimate, and is an estimate that does take into account the foreign-born population growth, which if you look at the foreign-born population growth, here it's a lot more volatile, unfortunately. But if you were to smooth it out, it would smooth out to something like 100,000 or less, maybe like 75,000 per month or something like that. So that's why I bring that up, is because, well, I mean, if you then, like I said, take that into account in the more recent data, it, like I said, and taking into account the revisions from 2024, it means that the job growth in 2024 basically was very weak, and depending on what you assume with the immigrant population, would have been largely bolstered by the immigrant population growth, as well as also people pointed out that a significant portion of the job growth was also government and healthcare, which is healthcare is very significantly funded by government spending. So a lot of it was very government too. So the point is, like, the job market was much, much, much worse in 2024 than it looked previously. And while it doesn't look better now, that's the thing, is like none of this is to say that the job market is good now in 2025. It's still like we still cut off all that immigration, which is going to lower the nominal amount of job growth. No matter what you think about the immigrants, that's just a fact that they were a nominal addition to our economic output one way or the other. The argument then becomes more about what is the per capita distribution stop immigration, which I'm amenable to that argument too. But the point is, immigrants are positives and negatives economic. It just depends on from whose perspective you're talking. So anyway, the point is I'm trying to make is that given the fact that we have no growth in immigration this year, the job market is not that bad. Like I said, it's not good. This is not a good job market, but it's not recessionary. That's what I'm saying. It's not recession. It's definitely not falling off a cliff into recession. It's just normalizing for the fact that there is immigration, no immigration, and that we were already in a downturn. So anyway, like I said, a lot of people will probably disagree with that. That hits on hot button topics and all that stuff, but I bring the data. Bring the data. That's all I'll say about that. And then also the other factor, the other thing to kind of take into account when it comes to those revisions, because a lot of people were getting very judgmental about the revision, because like I said, they threw out the previous head of the Bureau of Labor Statistics because of the revision. They're saying, like, oh, well, they were screwing up because of the revision. And so here's the thing I think people fail to understand about this, is that they were mad because, like I said, the month over month rate of change is what people were talking about, and this number was wrong. So like this number ended up, they would revise it and it would end up being half as much. And they were like, how could it be off by half as much? Like how are you could you be wrong by that much? Isn't that just crazy that it's literally half wrong? And it's like, well, no, because they're not trying to estimate the change on a monthly basis. That's not actually what they're trying to estimate. What they're trying to estimate is the total number of jobs. Okay. And so you have to think instead, like, what is that monthly change as a percentage of the total number? Because that's really the thing that they're reporting to you. They are reporting the total one. Um, they're reporting to you the total one, but the thing that they're actually trying to report to you is instead more like more like 25 basis. You can see it's literally like 25 basis points. The monthly change is like 10 basis points, 20 basis points, 30 basis points, 20 basis points, 10 basis points, 20 basis points. That's the thing that they're trying to report. So the fact that they got 10, like I said, if you assume maybe on average it's 20 basis points and therefore they're half wrong, that means half wrong is 10 basis points. That means their estimation error over the total value, which, like I said, is the thing that they're actually trying to estimate, this number here, the 160 million. And they are only like 10 basis points wrong on their estimate of the total number. You see my point? Like, that's actually not bad. That's not bad at all. That's actually very, very good. Very, very good statistic. It's just that people don't understand that that's what we're trying, they're estimating this number, but they're reporting to you this number, and that creates the confusion in terms of how good of an estimate the monthly change. To be honest, maybe they shouldn't report the monthly changeover. Maybe they should do the change from a year ago. Like, in some ways, I'm surprised they don't report it on like a yearly basis, because we do so many other things on a yearly basis. Like, we report inflation rates on a yearly basis. We report GDP on an annualized basis at least. I would prefer we use GDP on a year-over-year basis, but we at least use a quarterly annualized basis, right? But for some reason, with the jobs numbers, we just report the raw monthly change rather than like an annualized rate of change would be like this chart right here. So that's what I would say about the jobs. It's like, on one hand, I'm amenable to the idea that the jobs market is not that big of a disaster. It's, a lot of critics, I would say, of the administration would like to paint it to be. I'm sorry to all the critics of the current administration, but at least as of yet, we are not really falling into recession. Not yet. That could change 6 months from now. It totally could, and I will be here to report the next economic data over the next 6 months to tell you if that's the case. But it at least is not happening yet. If the tariffs are going to drag us into recession, it's going to be a late 2026 recession, probably at a minimum. But to be a critic to the fans of the current administration, I would say all this hullabaloo about bad jobs numbers, bad statistics, and the need to replace agency heads is all silly. It's all silly and just a poor understanding of the actual statistics. There's nothing wrong with those agencies. Their job is just really, really, really hard. So that's the thing, is like, to be honest, they do an incredible job with like what they're being asked to do. That's just the truth of that. So that's my opinion on all that. The kind of like last addendum to that is like the Fed independence discussion, because I've been talking about the agencies, but then there's also the Fed, which I put in the thumbnail on Stephen Myron, Dr. Stephen Myron, the new governor that has joined the FOMC chair recently, as of the most recent meeting. But it's also worth noting that there's Governor Cook, which was the another person in one of these agencies that the new administration has been trying to kick out of office so that they get replaced with their own person. And I'm not going to get into the gripes about her, the accusations against her. I don't really have an opinion about it. If what she did was bad, that's bad. But I also think that there's lots of um, selective enforcement of these rules for political reasons. So I'm in favor of fairly prosecuting everybody, and I'm also in favor of um, not prosecuting anybody if that's the way things have kind of always been. I prefer we prosecuted everybody, but I don't think it's fair to do it just because you want to get a new governor in there, so you get an extra vote to vote for interest rate drop, which is definitely what the current administration is trying to do. But nonetheless, with that, like I said, Dr. Myron is the agency's pick that did join the board. And I will say this: it's like, he is definitely a pro Trump administration person, obviously, so he certainly has his biases. But I do think he's actually very intelligent. I actually do think he's a very good, intelligent person that makes very good economic arguments. I don't always agree with all of his economic arguments. He did actually came out with a big speech somewhat recently, basically laying out um, all of like in the data. He actually like gave like specific numbers to his expectations and his assumptions about the economy in terms of why he thinks that have lower interest rates, which I appreciate. It was a very data driven explanation for it. Like I said, I would totally have my gripes with various parts of his explanation. Like I don't actually agree with his explanation, but I did think it was actually very, very data driven, and which is better than a lot of other people's arguments for why we should lower interest rates. But anyway, so I bring that up because then that gets to the question of like, okay, well, what's going to happen with the interest rates then? What's going on with that? What's happening? So coming over here to the Fed Watcher tool, we can see the expectations currently for the October meeting is basically 95% chance that we are going to get a 25 basis point cut. And so we're probably going to get that. Probably going to get 25 basis points more in December, people seem to think. And then we seem to think that we're going to be skipping a month or skipping a meeting for that one. And then we'll get another cut thereafter. And we'll probably be getting more members added to the FOMC over the course of months, which will maybe shift the dynamics in terms of the voting potentials. But then there's also the data to take into account too. So, I like I said, I've said this before. It's like you can cut the interest rate all you want. I'm sure the short end, but that doesn't decide what's going to happen on the long end of the curve because um, the longer term treasuries, like the 10-year treasury, are dictated more on combination of inflation risk plus a nominal opportunity cost, which is very similar to like real GDP growth. And then also there's kind of like a layered in risk to your to the government actually printing and paying back a little bit of a nominal payback risk as well. Generally speaking, but the point is, so the 10-year Treasury is effectively a combination of real growth plus inflation expectations, which basically makes it the same as GDP, nominal GDP, because nominal GDP is real growth plus inflation expectations. Over here. Should have just done it. Should have just done it on bed. I've showed it many times before. Not necessarily, but to find the look at that. Okay. Like the 10-year treasury and the year over year GDP growth rate. Pretty closely correlated with each other because they're effectively tracking the same thing. And I bring that up because, well, I mean, if you look at most recent uh, time frame here, uh, you know, where do you think GDP is going? Like this is that is what you have to ask yourself if you were saying, well, where should the 10-year treasury go? Where do you think GDP is going? Like right now, GDP growth has oscillated between a little under 3% to they're kind of similar. You can use the compounding annual rate of change, or you year over year. It doesn't shift it the correlation that much. They're kind of still kind of similar. It just shifts some of the volatility. But the point is like, what do you assume about GDP growth? That's the real question. And I mean, that's the question I think is relevant to the assumptions that Dr. Myron is making as well. So it's like, I've made the case that I don't think inflation is basically going to go below 2.5% without a recession, right? And I think that inflation could actually be as high as 3.5% without recession. And understand when I say that, I'm saying that over a 10-year period. That's the compounded rate of inflation I would expect 2.5 to 3.5. But my assumption being 2.5 to 3, I think like 2.75 is probably a reasonable assumption. So 2.75, if that's what I assume about inflation, then what are you going to assume about growth? If you assume that you want 2% of GDP, real GDP growth, and that means, and maybe we get lucky, like 2.5% of inflation, then that would mean 4.5% if you combine the two together. 4.5% on the treasury is not that far from where we are. We were at 4.5% in March, most recently, or in July, most recently. So yeah, that's what I would say about that. Like one of these things where it's like, what are you what do you assume about that? Because you can basically figure out where you think the 10-year treasury should be based off of just combining an assumption about real GDP and an assumption about CPI. And for the record, I mean, in financial monetary economic policy circles, this is what they call nominal GDP targeting. Like this is literally there's literally a name for the school of thought that believes that we should change the Fed funds rate to essentially track the 10-year with the GDP growth. Like that's what some people believe, and I effectively believe that. I think like if you're gonna try to wiggle the Fed funds rate around in general, like I personally don't think that the Federal Reserve should have an FOMC. Like personally, in my opinion, they should just let the Fed funds rate uh, be a market rate like anything else. Personally, but if you're not going to do that, then in my opinion, you should try to make it so that it correlates well with an actual market rate, which would be the 10-year Treasury tracking nominal GDP. And you would do that by basically tracking the spreads between them. You would basically say like, okay, well, the usual spread between the Fed funds rate and the 10-year is this, and we want nominal GDP, or nominal GDP is about this. So if I take nominal GDP and I subtract out that usual spread, then that will tell me where I think the Fed funds rate should be, right? And so like you, for example, here as well, I guess, to I assume back to here's the spread between the 10-year treasury and the Fed funds rate. So it's like it oscillates between negative 1 to 2% to positive like 3%. We can assume maybe it's let's just say like 1.5% on average. So if I think that therefore nominal GDP is going to be at like 4% or something like that, or if I think nominal GDP is going to be at like 4.5% or something like that, well then I should probably put Fed funds rate at like 3.5%, right? Like that would be what you could do and something like that. So within that 3.5%, well, what does the market think the Fed funds rate is going to go to? The market seems to believe that by mid next year we're going to be at like 3 to 3.25. So you can see that's pretty in line with that kind of way of thinking. So it gives you an idea like how do these estimates come to be? Well, people do have like theories about, like, oh well, these spreads are going to normalize to this kind of range, and then that's going to turn into this. Um, and then, like I said, they're making assumptions about GDP growth and assumptions about inflation. And I would say that's relevant too, because also I've talked about a lot in my various shows over the course of the year about my assumptions about the the yield curve, which is the time spread between different treasuries, 10-year and the 2 year. I've basically made the case that yes, there's been this uptrend in the yield curve over this period right here since basically like mid 2023, which was that recessionary time frame. Then the yield curve is normalized, and it's kind of flattened since April to a certain extent. We stopped increase, but in my opinion, this increase is likely to continue. Currently sitting at about 50 basis points. My assumption is that this is going to at least go to 75 basis points over the course of like the next year or so, but it could very easily go to 1.5. Like that's very possible that it ends up over here. But in my opinion, even if it just went to 75 basis points, I'd be happy, and that would be very good for FG's profit in general, their future profits, their forward profits, not necessarily their profits in 2026, but in the years following that, their profit. So um, we'll probably talk more about that relationship next year. I did do a lot of research on that. Like I've talked about this a lot over the last year, but um, unfortunately, like if you're looking at like, a lot of data sets, it'd be hard to find this data. Um, like because like I know I showed this related to an insurance ETF, for example, and I was like trying to show like the correlation um, between the movements of this. I know I did this like on a previous stream at one point, which you can do. That's definitely a thing you can do. But the problem with that is that like I was using an ETF that only goes back to 2006, which is very limited amount of data. So literally in the last couple of weeks, I've done a lot more data. I've done a lot more research, going back and finding data on insurance company and other industry returns going back many, many, many decades. which I didn't want to make that a feature of today's stream, so we'll probably talk about that like the next time. But very, very cool stuff I discovered. The spoiler alert is that everything I've said about how insurance companies are affected by interest rates over the course of like all my streams this year is definitely true. Definitely true. Just maybe more detailed complications to figure out with that. But anyway, like I said, we'll talk about that in next. So with that, that's probably going to be it for today. Almost 2 hours today. Very good, nice long stream. Talked about tons of economic data. Hopefully, some of you that are super bullish on the economy and believe this is the best economy ever now have a better understanding of some of the risks out there to the employment situation, the liquidity situation, and various things like that. There are significant parts of the economy that are going along strong, but there's definitely areas of weakness that, like, if not addressed very carefully, could be an issue. Before I close out, there was actually one other detail I did sort of want to mention. One of the reasons I did start going in and talking about the Fed and the Fed independence and the fact that we are getting interest rate cuts, because that kind of does relate back to that the SOFR liquidity measure I was showing, and the strain we've had in the short-term dollar funding markets, because the short-term dollar funding markets will be alleviated by a drop in the Fed funds rate. So that this motion downward should actually start to help to alleviate these issues that have been getting hotter and hotter throughout the last couple months here. So that's good. That's technically one positive to lowering the Fed funds rate. Like I said, like lowering the Fed funds rate probably is going to exacerbate inflation in the coming years, which in some ways, like I said, is I think actually sort of a goal. Like I think they're willing to accept 3% inflation if they get higher growth out of it. I think that's basically what they're secretly under the table basically agreeing to, is that they're like, well, you know what, 3% inflation is actually not that bad as long as we're not going below 2% growth. Like they're hoping to get 3 to 4% growth, but they for sure cannot have under 2%. And so I think that's the thing. It's like they're like, well, you know what? If we end up with 3% inflation and we end up with 2% growth for sure with that, we're willing to settle for that. But if we also get 2.5% inflation and 3% growth, that would be great too. But all of those things equal is higher interest rates, higher long-term interest rates. You can have lower short-term interest rates, but you're going to have higher long. Anyway, that's going to do it for today. Hope those of you who watch it on the replay enjoy the stream. Please like the stream. Like I said, it really, really helps the stream if you do. Subscribe if you haven't already. Join the Discord if you haven't already. And maybe send me a donation via PayPal if you haven't already. I really appreciate it. All right. Catch you all in the next one. Thanks.